Welcome to the deep dive. Today we're cutting through the noise on the U.S. stock market. We've got a whole stack of analysis, data, market commentary, all focused on yesterday, June 11th. And we're using that to figure out the outlook for, well, the next 24 to 48 hours, so June 12th and 13th, 2025.
Right.
Our mission's pretty simple. Pull out the key insights, make sense of signals that might seem, contradictory, and really understand what's driving things right now. The goal is to get you informed fast.
Yep, gets you up to speed quickly. And yesterday, June 11th, it was definitely a day with some interesting cross currents, especially after the strong run we've seen lately.
Exactly.
The market didn't quite react as you might have initially guessed.
That's where it gets really interesting, isn't it? So let's start with the big picture. Yesterday, Wednesday, June 11th, we saw the main indices, S&P 500, Nasdaq, Dow, Russell 2000, they all pulled back just a little bit.
A slight pullback.
Yeah, it felt like a pause, maybe catching its breath after that recent climb.
And what's fascinating, like you said, is that this pullback happened even though we got some genuinely encouraging news.
Right.
It wasn't a sell-off driven by bad news. It was this slight retreat amidst good news, which really makes you reassess what's actually moving the needle in the very short term.
Okay, so what was this good news that the market kind of shrugged off, at least at first glance?
Well, the main catalyst was a report showing May 2025 inflation. It ticked up less than economists were expecting.
Okay, less inflation. That's usually good news.
Fundamentally positive, yeah. Because it dials back the pressure on the Federal Reserve to keep interest rates high.
Yeah.
It, boosts the odds of rate cuts later in the year.
Which helps stock valuations.
Exactly.
Yeah.
Especially for growth stocks, because it lowers the discount rate applied to their future earnings, making them worth more today.
And we saw Treasury yields ease up a bit in response to that inflation data too, right? Lower yields are another plus for growth stocks.
Precisely. And then on the international side, we also had the U.S.-China trade talks wrap up.
Right.
The U.S. Treasury Secretary called them successful, aiming for balance.
So a constructive tone there usually helps calm nerves.
Generally reduces that global uncertainty, even if it's just preliminary steps.
And the Treasury also put out a statement, didn't they, highlighting the administration's economic view.
They did, talking about boosting growth, things like making the 2017 tax cuts permanent, incentivizing manufacturing. I think there was mention of a One Big Beautiful Bill Act.
Oh, okay.
And they use phrases like laying the groundwork for a golden age economy,
Yeah.
pointing to slower inflation since 2021 and a strong job market.
Right, that's the administration's narrative from the sources we looked at, framing things positively.
Yeah, and those fiscal policy narratives, they can definitely sway broader sentiment, even if the direct market impact isn't always, immediate or super obvious.
Okay, so let's recap. We had positive inflation surprise, easing yields, maybe some better trade vibes, a positive domestic story from the admin. All sounds pretty good. Yet the market paused. Why the disconnect? What gives?
Well, that's where you really have to look past the big indices and drill down into specific company drivers.
Yeah.
Because the major new piece of news actually hit after the market closed yesterday.
Oracle.
Or RCL. They reported their Q4 earnings.
Oh, really?
Pretty strong. Revenues were $15.9 billion, up 11% year over year. Adjusted earnings per share, $1.70. Both of those beat what analysts were expecting.
And I bet their cloud business was the real story, right? Given the whole AI narrative.
Oh, absolutely. Cloud services and license support revenue up 14%. But their cloud infrastructure revenue, that's the really key part for AI and compute power.
Right.
It jumped a staggering 52%.
Wow, 52. That's huge.
Yeah, a huge number.
Yeah.
And maybe even more compelling, their RPO remaining performance obligations. Think of that as like future revenue they've already booked some contracts.
Gotcha. Locked in.
Exactly. That surged 41% to $138 billion. Plus, Oracle CEO actually projected dramatically higher revenue growth in their next fiscal year, FY26.
Okay, those are serious growth signals, especially for a company that size.
They really are.
Yeah.
And the market's reaction, well, it shows that complex picture we started with. While the broad indices did that little pause with maybe some profit taking, maybe a bit of sell the news on the inflation data.
Right, cashing in after it landed.
Oracle's strong report sent its shares flying up around 7% in extended trading.
So peeling back the layers then, it sounds like the market's weighing these positive macro signals, like inflation may be opening the door for Fed cuts against the need for specific companies to actually show that growth is happening. The pause yesterday, even with good inflation news, suggests maybe a more discerning market. cautious perhaps after the run-up, waiting for proof.
I think that's a really accurate synthesis. It suggests investors are looking for validation company by company. And you've got other factors too, like rising oil prices kind of bubbling in the background, adding another layer.
So it tells us that for the next day or two, we're in this environment where these big narratives meet individual company performance head on.
That's it exactly.
So how does that translate into, likely scenarios for the market overall in the next 24, 48 hours?
Well, based on our analysis of the sources, we kind of see three main paths shaping up. Scenario one, maybe about a 60% chance, is that the bullish news wins out.
Okay.
So that dovish signal from inflation combined with Oracle's really strong tech results that could fuel what we're calling a dovish catalyst and tech rebound, especially lifting those tech-heavy indices.
So yesterday was just a quick breather and tech takes the lead again.
That's the idea. Scenario two, maybe a 25% probability, is more like consolidation and sector rotation. Meaning the market might just trade sideways, kind of range-bound. Investors shuffling money between different sectors as they digest everything, rather than pushing the whole market strongly one way or the other.
And the less likely downside scenario.
Scenario three, maybe a 15% chance, is broader profit-taking, where, despite the good news, selling pressure near these recent highs just picks up steam, and the indices start testing lower support levels.
Okay, so a market that wants to go higher, maybe, but is also ready to cash in some chips if the company stories don't universally impress or if, technical levels start to break.
Yeah, feels right.
So how do we take this big picture view and apply it, like down to individual stocks?
Yeah, this is where the divergence really pops, where you find these really interesting situations. We've pulled out a few specific stocks that have fresh news, lots of activity, shifting sentiment. They really illustrate these different forces at play, everything from large caps to momentum names, even a pure spec play.
Excellent. Let's dig in, starting with the one that gave us the biggest news yesterday, Oracle, ORCL.
Right. Oracle, clearly emerging as an AI cloud breakout story right now. Like we said, the Q4 earnings beat, that super bullish guidance, those were the catalysts, especially that 52% cloud infrastructure growth and the huge jump in future contracted revenue, the RPO.
After a move like that post-earnings, what are the charts telling us? Is it looking overheated already?
Well, the technical picture is actually strongly bullish. Indicators like MACD, which looks at moving average momentum, are flashing buy. The RSI, the Relative Strength Index.
Measures oversold, right? 0 to 100.
Exactly. It's up around 65.4. Now, that's approaching overbought territory. Usually above 70 is the warning zone. Yeah. But 65.4 right after good news mainly confirms strong momentum. It's not an immediate red flag like, say, 80 or 90 would be.
Oh, okay.
Prices well above key moving averages, well above yesterday's average price, VWAP. And the high volume after hours really confirmed that buyers were convinced. Overall technical score from the sources, 88 out of 100. Pretty strong signal.
And what about the quant side? Like, who owns it? Anyone betting against it?
Short interest is pretty low, only about 1.48%. So not many people betting against it. A short squeeze isn't really in the cards. Institutional ownership is high, around 44.5%. And importantly, the sources show net buying from these big institutions last quarter.
So the big money was adding shares.
It seems like it. And what's really interesting here is the activity before earnings in the dark pools, those private exchanges.
Right.
We saw significant bullish options flow. About $2 million in premium paid for calls, with $1.2 million of that tagged as whale trades, big, potentially informed money.
Betting on upside before the news hit.
Exactly. And, well, that proved pretty predictive this time.
So the smart money, or at least some big players, seem to be positioned correctly. How did that translate into the general feeling, the sentiment?
Sentiment now is decisively positive. You can feel it. The news sparked excitement, confidence, and, yeah, probably a bit of FOMO, fear of missing out.
Sure.
The after-hours press jump shows that. The expectation now is for continued growth, analyst upgrades are likely coming, and Oracle's being seen as a real, tangible play on enterprise AI infrastructure. Media buzz is high.
So for Oracle, it seems like everything's pointing the same way. Fundamentals, technicals, the quant data with the whale trades, the positive sentiment, no real conflict here.
Pretty much. It's quite aligned. The earnings report was just that powerful, fresh catalyst that seems to have pushed aside any prior doubts. It's a great example of how real, tangible growth tied to a huge theme like AI can get a strong, unified reaction from the market.
So what's a short-term plan then for Oracle, given that strong bullish bias?
Yeah, high confidence on the bullish side. Let's call it a 75% probability for more upside in the immediate term, say the next day or two. The trigger for a continued bullish move would be if the stock holds above that $188 to $190 zone.
Okay.
If it does, the first target is that psychological $200 level. Then maybe $205 or even higher. For risk management, a stop loss probably makes sense somewhere below $185.
Seems like a decent risk-reward setup.
It does. And Oracle really shows that this AI story isn't just, abstract hype. Companies providing that core plumbing, the infrastructure, they're seeing real dollars flow, and the market's validating that.
Okay, that's a strong, clear thesis for Oracle. Now let's pivot to a completely different picture. Apple, AAPL. The stock actually fell yesterday, and it's been struggling this year, hasn't it? Down quite a bit year to date.
Yeah, Apple's definitely navigating some serious headwinds. It really shows how even the biggest market leaders aren't immune to specific challenges. The market's still kind of digesting the Apple intelligence stuff from their recent conference, WWDC.
Right.
And while their services business is still a bright spot, there are these nagging concerns that won't go away. Weak iPhone sales in China, the potential hit from tariffs, and just, more competition, especially from companies like Huawei in key overseas markets.
And the AI features themselves got a bit of a mixed reaction.
Some participants felt they were maybe a bit lackluster, at least in terms of immediate must-have consumer impact compared to what some others are doing. Promising long-term, perhaps, but not a game changer today.
So the sentiment's already a bit iffy, even with the AI push. How do the charts look? Does that reflect the pressure?
Oh yeah, the technical picture is strongly bearish, according to the sources. Indicators like MACD are negative, signaling selling pressure. The RSI is down at 34.
Getting close to oversold, below 30.
Close, but not quite there yet. But the trend is clearly weak, putting it in sell territory. The stock's trading below key moving averages, and recent volume patterns suggest distribution, basically, more selling than buying.
Any key levels to watch?
Yeah, there's technical support seen around $195 and resistance up near $213. The overall technical score is really low, just 22 out of 100. Stark contrast to Oracle's 88.
Wow, yeah. What about the quant side for Apple? Who owns it? Any shorts?
Short interest is super low, about 0.7%. That's typical for a giant like Apple, so a short squeeze is really not a factor. Institutional ownership is huge, almost 70%. The big funds own a lot of it.
But are they buying or selling?
Well, the sources indicate a small net decrease in institutional holdings in the most recent quarter. Not a mass exodus, but a slight trimming.
Interesting. What about options?
Options open interest leans slightly towards calls overall, which you might think is bullish. But there's a lot of call open interest specifically at the $205 strike price expiring tomorrow, June 13th.
What does that usually mean?
Often, that kind of concentration suggests people might be selling those calls, betting the price won't go much above $205 by expiry, or it could be hedging existing positions. It's less likely to be pure bullish bets on a big surge past that level right now.
So sentiment seems caught in this tug of war. Long-term hope from AI and services versus these near-term anxieties about China, tariffs, competition, and just the fact the stock's been down all year?
Exactly. You see analysts on average still saying buy with pretty high price targets, but when you look at platforms like investing.com, where actual traders voice opinions, the leaning is more bearish. Social sentiment is positive overall, but trending slightly down.
Okay, so the signals here are definitely more mixed than Oracle. The technicals look quite bearish, maybe more so than the sentiment, which still holds some hope.
Yeah, it feels like the persistent negative news flow and that established downtrend are kind of outweighing the longer-term hopes for now. It just shows how even the giants can face these sector-specific and geopolitical issues.
So the short-term bias leans bearish here. What's the actionable plan?
We lean towards a bearish to maybe neutral bearish bias. Let's say a 65% probability for the bearish scenario playing out. The trigger for a move lower would be if it breaks convincingly below that $195 support level we mentioned.
Okay, watch $195.
If that breaks, the next targets could be down around $190, maybe even $185. A stop loss to protect against a reversal would probably sit above $202.50.
But you mentioned it's approaching oversold. Is there a chance of a bounce?
Absolutely. You have to acknowledge that possibility, maybe a 35% chance. If $195 holds firm, or if some unexpected good news hits and pushes it back over $200 plus intrasight, you could get an oversold bounce. So you need to be mindful of that too. It's a situation that really highlights how investor caution can make a stock lag, even when parts of the business are solid.
Right. Okay, let's shift gears again to the momentum side. CoreWeave, CRWV. This AI hyperscaler IPO has been, well, just on fire, up over 300% year to date, tacked on another 8% yesterday.
Yeah, CoreWeave is just a prime example of a pure momentum story running hot right now. And it's all built on this narrative of explosive growth in AI computing infrastructure.
And its ties to Nvidia, right? And Google, OpenAI.
Exactly. Those partnerships add a lot of credibility and fuel the hype.
But the story isn't all sunshine and rainbows, is it? There are some sharp contrasts here.
Oh, absolutely. That explosive growth narrative is slamming right up against its current financial reality, which is, well, it's not profitable yet. It's taken on significant debt to fund this massive build-out. And the valuation multiples are extremely high, like a price-to-sales ratio around 20 or 21. That's very stretched, even for a growth story.
So for a stock moving this fast, with those fundamental question marks, what do the charts show? Is it just straight up?
The technicals show incredibly strong momentum, yes. Bat T, and but it comes with a huge flashing warning sign. It is extremely overbought.
Okay.
MACD is bullish, confirming the rally. High volume shows buying conviction. But UT, the RSI, is way up at 81.91.
Well above that 70 overbought line.
Way above, screaming overbought. Stochastics, another momentum gauge, also super high at 93.94. The price is trading outside its upper Bollinger Band, that's a technical channel, and trading outside it often suggests a move has gone too far too fast.
High volatility too, I imagine.
Extremely volatile. The ATR, average true range, which measures the typical daily price swing, is over $8. The technical score is high, 84, reflecting the strong trend, but that extreme overbought reading is a massive cautionary flag.
Quant Insights. Given the valuation concerns, maybe high short interest?
Yep, significant short interest, around 8.44%. That could provide fuel for a short squeeze if the price keeps ripping higher.
There's always a but with this one, it seems.
But here's the conflict again. The borrow rate, what shorts have to pay to borrow the shares, is insanely high, over 172%. That tells you two things. One, there's serious conviction against the stock based on its valuation. People are willing to pay a fortune to bet against it. But two, it makes shorting extremely expensive and risky, which ironically increases the potential for a violent squeeze if good news hits or momentum just keeps going.
What about ownership?
We've seen rapid institutional accumulation since the IPO, ownership around 60%, including Nvidia as a key strategic investor. Option signals are pretty mixed, and there's high off-exchange short volume, suggesting persistent selling pressure happening away from the main public markets.
The sentiment must just be a battlefield then.
Intense doesn't even begin to describe it. You've got incredibly strong FOMO and hypa, the AI story, the Nvidia connection, the price chart itself clashing head-on with deep, deep skepticism about the valuation, the debt, the lack of current profit. It's a classic battleground stock. Retail and media attention is exploding.
So trying to resolve these signals, those extreme overbought tech tools seem like the most immediate urgent warning sign, right? Even with the strong momentum and squeeze potential.
That really feels like the crucial point for the immediate term, the next day or two. While the narrative and momentum are powerful forces, those extreme overbought readings are historically a high probability signal for, at the very least, a pause or a pullback soon. Even if the longer-term story turns out great, it really shows that tension between market mania and fundamental grounding.
So what's the short-term plan for CoreWeave? Sounds like caution is warranted.
Yeah, we'd lean neutral, but with a bias towards thinking a pullback is likely. Maybe a 60% probability for that scenario. The trigger would be if it fails to make a new high above $167 and starts trading consistently below $160.
And if it does pull back, where might it go?
Targets could be around $145, maybe down to the $135, $130 area. A stop for a bearish play would be back above $167. The risk-reward for betting on a pullback here is roughly 1 to 1.44.
But you can't ignore the other side.
Absolutely not. You have to acknowledge the bullish momentum squeeze scenario, maybe a 40% probability. If the hype just continues and it breaks convincingly above $167, you could see shorts scrambling to cover, pushing it even higher, faster. This stock is just a textbook example of momentum versus fundamentals and the big risks involved in chasing something that's already this extended.
Okay, next up, another momentum name, but one with a really dramatic last 24 hours, Oklo. Oklo, the Sam Altman-backed nuclear tech company. It soared yesterday, right? Then something happened after hours.
Yeah, perfect example of event-driven volatility playing out right in front of us. The huge surge yesterday, up over 26% on massive volume, was driven by positive news.
What was the news?
They were selected as the intended awardee for a power supply contract at Eielson Air Force Base in Alaska. That's potentially major validation for their microreactor technology. Builds on the Sam Altman backing, progress with regulators, long-term very positive signal.
But then came the after-hours news, which wasn't so positive, short-term at least.
Exactly. After that big celebratory jump, Oklo announced a proposed public offering of common stock. They're looking to raise over $400 million.
Okay. Raising money can be good long-term, gives them capital to grow, but doing it right after the stock spikes, using a stock offering, that usually means dilution for current shareholders, doesn't it?
Precisely. And that's why the market often reacts negatively in the short term. It potentially increases the number of shares out there, making each existing share represent a smaller piece of the company, and it just increases the supply of stock available to be sold.
So how did that news slam into the technical picture, which must have looked great after the 26% jump?
Well, before the offering news, the technicals showed really strong bullish momentum. Powerful trend, trading above key levels. About T, just like CoreWeave, it was extremely overbought after that surge. RSI was up around 78.93.
Also very high.
Very high. High volatility too, ATR around $5.54. The technical score was 82, reflecting the strong move, but again with that major overbought caution attached.
And the quantitative picture must be dominated now by this offering news.
Definitely. There's significant short interest here, reported anywhere from 8.7% up to maybe 14.9%. That could normally fuel a squeeze. But this offering might actually put more shares into the market, potentially giving shorts share to cover easily, or just increasing the overall float available for new short positions.
What about ownership?
Institutional ownership is moderate, maybe 25–35%.
Yeah.
Sources showed a net decrease last quarter, though. There was some bullish dark pool options flow before the offering news, probably people anticipating that contract win. But yeah, the offering itself is now the dominant new quant factor, that direct risk of dilution and increased share supply hitting the market.
Sentiment must be just whiplash central.
Acutely mixed doesn't quite cover it. Intense excitement from the contract win, the Sam Altman angle, the future potential, crashing right into uncertainty and concern about the dilution from this offering.
Yeah.
Highly conflicted, likely set for extreme volatility today and tomorrow. It perfectly illustrates how corporate finance decisions like raising capital are critical events that can immediately overpower even great operational news.
So, resolving these signals, we've got bullish operational news hitting potentially bearish financial news right on top of an overbought chart. How does that likely play out today or tomorrow?
The stock offering is the newest, most direct financial signal impacting the stock's value per share. And historically, these kinds of offerings, especially after a big run-up, tend to cause immediate price pressure. The market reacts to the dilution risk and the incoming supply. That pressure often overwhelms the positive operational news in the very short term, particularly when the stock was already technically stretched overbought.
So the bias leans bearish purely because of the offering's immediate impact.
Yeah, high confidence in a near-term pullback due to the offering. Let's say a 70% probability for that bearish scenario. The trigger is probably going to be the market open today. If it opens significantly lower because of the news and breaks below a key level like $60,
Then look out below.
then targets could be $55, maybe the $52 zone. A stop loss would need to be placed above $65. Now, because it might gap down significantly at the open, the risk-reward for initiating a traditional short right away might be less attractive, maybe only 1 to 0.67 initially. So traders might need to adjust strategy, maybe wait for volatility to calm, or use options.
But there's still a chance the buying pressure overwhelms the offering.
You have to acknowledge that, yeah, maybe a 30% chance. Perhaps buyers are so keen on the long-term story and the contract win that they absorb the offering shares quickly and the stock shows surprising resilience. But the typical pattern points towards near-term pressure. It's just a classic case of an event-driven stock where corporate actions have immediate, dramatic consequences.
Okay, finally, let's touch on Society Pass, ILSOP. This one's way down the speculative end, right? Microcap trading just over $1.
Yeah, this is a very different kind of situation. Really illustrates the extreme end of speculative investing. It's an e-commerce and fintech company focused on Southeast Asia. And based on the source material, the entire investment case, all the hope pinned on this stock, seems to revolve around potential future IPOs of its subsidiary businesses, supposedly planned for 2024-2025.
So the current price is basically a bet on those future IPOs happening and being successful, not based on current business.
Exactly. That forward-looking hope is pretty much directly countered by the current reality. Poor financials. The latest report showed declining revenue, negative earnings.
But some analysts are still bullish.
Despite the weak numbers, some analysts have these very high buy ratings, with targets like $15. But looking at the analysis, those targets seem based solely on the potential speculative value of those future IPOs, completely ignoring the current operational struggles. Other sources, like MacroAxis, flat out call it very risky.
The technical picture for a stock like that, so disconnected from fundamentals, must be pretty messy, unreliable.
Mostly bearish to neutral, and yeah, very unreliable. When fundamentals are this weak, price action tends to be driven by unpredictable spikes on news or rumors or just random volatility, rather than following clear technical patterns. The technical score is very low, 32 out of 100. It just lacks any solid technical foundation.
Quant insights. I'm guessing very little institutional interest.
Extremely low. Institutional ownership is tiny, around 3.74%. That confirms it's overwhelmingly retail-driven, a speculative play not held by the big funds. Now, there's conflicting data on short interest, but the higher figures put it possibly around 6.9%, and significantly, with a very high borrow rate, over 100%.
What does that tell us?
If accurate, that signals major market skepticism despite the low price. People are paying a lot to bet against it. It does create potential for a short squeeze on any random positive rumor, but the baseline signal is negative. And there's basically negligible dart pool or options activity, no signs of informed money playing here.
So sentiment is just this sharp divide. Hope for the lottery ticket payoff if an IPO hits, versus deep skepticism and frustration with the current weak fundamentals.
Precisely. Highly polarized, driven by retail hopes and fears, and incredibly sensitive to any whisper of media hype or rumor about those potential IPOs. It really shows you a purely speculative arena where today's reality often takes a backseat to tomorrow's maybe.
Okay, so resolving the signals here seems pretty clear.
Yeah, the overwhelming weight of evidence points one way. Weak fundamentals, poor technicals, almost no institutional interest, and potentially high short interest signaling doubt. All that overrides the purely speculative, future-based analyst hopes. The most probable baseline scenario without a concrete catalyst right now is just stagnation at these low levels or maybe drifting lower.
So what's the short-term plan, or rather the outlook for society pass?
Bearish to neutral bias seems appropriate. Medium confidence, maybe 65% probability of just stagnating or drifting lower. The trigger is simply continued failure to attract real buying interest above $1.50, especially on low volume. A potential target, if it keeps drifting down, could be the $1.15 to $1.20 area. A stop would be somewhere above $1.60.
Not really attractive for shorting either, though.
Probably not.
Yeah.
The risk-reward isn't great given the low price and the ever-present risk of a random rumor-fueled spike.
Yeah.
You do have to acknowledge that speculative pop scenario, maybe 35% probability. If there's sudden clear news like an actual IPO filing or a major investment or just a coordinated volume surge pushing it above $1.70, it could squeeze higher quickly. But this stock is really only suitable for investors with extremely high risk tolerance who are essentially gambling on a binary future event.
Okay, wow. Quite a range of situations there. Let's try to unpack this and connect the dots from that macro picture we started with down to these very different individual stories. What are the key insights that really jump out when you put it all together?
Well, a few things become pretty clear, I think. First, Oracle's strength. It could be signaling broader health, or at least opportunity, in the whole enterprise cloud and AI sector. It validates that this critical infrastructure part of the AI story is translating into real business, real dollars.
That makes sense. It's not just about the flashy consumer AI features. It's the plumbing behind it all that's showing the money right now.
And that leads to the second point. The market seems to be getting much more specific about AI. It's clearly differentiating between that infrastructure enterprise side, where Oracle and even the hyped CoreWeave are seeing traction, and the consumer AI side, where Apple is facing more scrutiny about the immediate impact and, how different it really is.
So investors are maybe prioritizing the behind-the-scenes AI right now, the business tools over the consumer toys.
It certainly looks that way based on these examples. That's a really significant distinction for anyone thinking about investing in AI.
Definitely. What else?
Well, the momentum stocks, particularly Oklo, they vividly show how crucial corporate finance decisions are. They're event-driven catalysts. Announcing a big stock offering, even right after landing a fantastic contract, can totally change the immediate price direction because the market reacts instantly to dilution and supply concerns.
Yeah, a major operational win just got overshadowed, at least for now, by a financial decision.
Exactly. And then finally, the speculative microcaps like Society Pass. They're just stark reminders, aren't they? Some stock prices are completely untethered from current reality, floating entirely on hopes for uncertain future events. And that high short interest in SOPA really signals how skeptical the broader market is about those hopes actually panning out.
Okay, so based on all that analysis, pulling it together, what's the strategic takeaway? For someone looking at the market for the next day or two, trying to have a balanced approach to risk.
Selectivity. That's the absolute key right now. It seems you should focus on the strongest fundamental catalyst you can find. Oracle's bullish setup looks the most compelling and straightforward from our examples. Then, be cautious, but maybe tactical about event risk. Oklow's offering likely means short-term pain, so maybe avoid it or look for specific trade setups carefully, managing that volatility. Observe the trend. Apple still is technically weak, bearish if that $195 support breaks, but keep an eye out for potential oversold bounces.
And core weave?
Exercise patience. It's just way too overbought for a fresh entry right now in our view. Better to wait and see if a more attractive pullback develops. And Society Pass. Understand it's pure speculation. Unless you have very high risk tolerance and some specific insight into a near-term catalyst, it's probably best avoided.
So it really boils down to picking your spots carefully, understanding what specific force, macro, earnings, corporate finance, pure narrative hype is driving each individual stock, watching those key technical levels like hawks, and always, always managing your risk.
Precisely. In this kind of environment, with these mixed signals and very specific company drivers, being selective isn't just helpful, it's crucial.
What really stands out to you from this deep dive then? I mean, you can really see how one piece of broad news, like that inflation data, can shift the whole macro view, while a single company's earnings report or a corporate action like Oklow's offering can completely redefine its individual story almost in the blink of an eye.
Yeah, and for me, this divergence we're seeing in the AI focus is particularly telling, maybe the most interesting thread right now. If Oracle is showing such powerful growth in the enterprise AI infrastructure,
Right.
but Apple's consumer AI rollout gets a more lukewarm, show-me kind of reaction, it really poses an important question, doesn't it? Are investors right now fundamentally prioritizing that behind-the-scenes AI horsepower, the enterprise solutions, over the more visible consumer-facing features?
That's a great question.
And if they are, what does that actually mean for the broader AI race? And maybe more importantly for listeners, how should we think about investing in this massive theme going forward? Is the smart money focusing on the plumbing for now?
Thinking about questions exactly like that is how you get ahead, isn't it? That's really the power of digging deeper into the sources connecting these dots.
Absolutely.
So if you found this deep dive valuable and you want the fastest, most frequent updates and insights like this, digging into what's really moving the markets, make sure you're subscribed.